Tough times for BlueScope Steel at the moment. The company's posted a $55 million loss for the past 6 months as it fights the headwinds of record raw material prices and the strong Aussie dollar. Domestic demand is also down as Australian manufacturers struggle to compete. Here's Emily Stewart.
It may be boom time for iron ore miners, but for steel manufacturers, times are tough.
We've seen a huge amount of upward volatility in raw material prices, and that's basically sucked all the profitability out of BlueScope's operations for the moment.
We're spending about $2.5 billion purchasing those raw materials a year. Since 2002, that's a tenfold increase in the cost of iron ore and an eightfold increase in the cost of coking coal.
BlueScope Steel posted a loss of almost $55 million for the 6 months to December 2010, a bigger loss than the same time the previous year. One of the factors influencing the result is the high Australian dollar.
It obviously makes it very tough to compete against imports, but also the returns you get in Australian dollars from an export perspective are lower. Very simply, at parity, if we were at 80 cents to the US dollar, we probably would have had a profit of full-year profit of closer to $200 million.
BlueScope says it's looking to break into the iron ore market to try and bring down costs, but analysts say it's unlikely for another few years.
I think you would expect to see BlueScope go out and pay top dollar for iron ore assets at this stage. They would like to buy something they can integrate 100% into their operations and control, and I think it'll be quite hard to get that in the current market without paying a huge premium.
With higher steel prices forecast, BlueScope expects to deliver a break-even result for the second half of the financial year.